Welcome to the series of Those Damn Terms, in which we try to understand one important finance term in the simplest possible manner, that too in 5 minutes. Today's term of discussion is PE ratio. PE ratio is nothing but the price of the stock divided by the earnings of the company. This earnings is nothing but the earnings per share or EPS we discussed in one of the previous videos. Imagine there is a company in which you invested. The earnings per share or EPS is 2 rupees, which means for each share you hold in the company, the earnings generated by the company are 2 rupees. The price of the stock is 50 rupees. P/E ratio here is nothing but price of the stock divided by its earnings per share. So in this case 50 by 2, that is 25. So let's remember P/E ratio is nothing but the price divided by earnings. That is the price you are willing to pay for each rupee of the earnings that the company is generating. Simple, right? As an example, let's calculate the PE ratio of HDFC Bank. Where do you get the share price? Let's go to Money Control website and search for the stock HDFC. Let's put the stock price here. Where do you get the EPS? Let's go to Money Control again. Scroll down to search the financial ratios. There it is. Let's take the EPS. So the stock price divided by EPS here is 26.57, which is nothing but the PE ratio for this company. Well, this is a basic idea. There are of course many other variations, like some people consider the past earnings in the calculation of PE ratio. Some use future earning forecast. Let's not get into those complex details. Anyway, we don't have to calculate these ratios. They are available for us to use. Let's remember for now that analysts provide us a PE ratio to give us a sense of how much money an investor is willing to pay for each rupee of earnings generated by the company. Or, in other words, how expensive is this stock? Usually speaking, a higher PE ratio means people are willing to pay more price and the stock is expensive. Why are people willing to pay more? Maybe they believe the company will do better in future, or maybe people are emotional and over optimistic than they should be. We don't know. So, if you have to select between two companies, just look at the PE ratios. Whichever stock has lesser PE ratio, just choose that because it is not expensive. But wait, is that all? Definitely no. Let's consider two stocks, Company A and Company B. Company A has PE ratio of 20, Company B 30. Just because Company A looks inexpensive with a lesser price to earnings ratio, should we buy A? Investing is not that simple. Let's first understand why people are willing to pay more for Company B. Let's look how fast Company B is growing. Company B is expected to grow at a rate of 40%, while Company A is expected to grow at a rate of say 10%. Now, do you think it is worth paying more and buying stocks of Company B because it will grow more and give us more earnings in future? Just think. The answer is maybe yes. If you see a lot of potential in it, you can buy it by paying more. So, if you just look at PE ratio, Company A looks good to you. But if you factor in the growth potential, you may be willing to pay extra bucks and buy Company B. That's where another factor called PEG comes into picture, which is a topic of discussion for another day. Overall, what I mean to say is PE ratio should never be looked at in isolation. It should be considered along with many other factors which we will discuss in future.